All right, ladies and gentlemen, welcome, welcome, welcome. It is December 4th, 2023. We are in week number 6 of our training. Last week we covered some technical analysis, and last week we learned how to establish our Bollinger Bands. We learned how to take a look at moving averages. And so we really got an opportunity to start looking at when was the best time to get into a stock if you're going to get into a stock. And so I want to just cover that real quick, and then we will be going back into our next training here for tonight. So Robert says he's moving back to Georgia on that midnight train to Georgia. All right, let's go. So I wanted to share with you, we're looking at Google here. And so Google had earnings come out back here on October 25th. And you can see that on October 24th, Google was trading, what's this? Google's trading about 138, 139 on October 24th. And then it had its earnings announcement, and then it dropped all the way down here to about 126, 125. Give me one quick second, guys. My apologies. Yes, sir. How you doing? Yeah. Okay. No, just go back to the regular ones that you were doing before. I switched everything back to where it was before. So when you log in, you'll have the one that was scheduled for today at 9 p.m. And then just go in that, and when they go to my Econ BPM, they'll be connected to that. All right, no problem. All right, bye. All right. Sorry about that, guys. Sometimes work calls. But you'll see that Google dropped down here, and it went down to about 126, 125. I went ahead and purchased on this particular day. And then the next 2 days, it went even further down to about 120. I think this is about 123. Okay. And then as you can see, that meant that it pierced below the bottom of the Bollinger Band. And so I purchased, and then of course the stock started taking off again. And so the stock got as high as about 140. And then some things just kind of been slowly creeping back down. And today it's at 130, but we can see that the bottom of this Bollinger Band is about 129, right? So if I scroll in here, you can see that it's about to hit the bottom of that particular Bollinger Band here. And so just keep your eye on Google if you're thinking about getting some Google, or if you're thinking about, those of you that know how to trade options, if you're thinking about getting an option, take a look at Google, take a look at, what's been going on here over the last couple of weeks. But I'm still holding. So I got mine at 125. I'm still holding, and may pick up some more shares if it drops a little bit further. I needed to drop probably further than 129, even though that's the bottom of the Bollinger Band. But these Bollinger Bands really do work, right? So when we look at the Bollinger Bands and you look at the history, every time it gets close to the top, it bounces down, it gets down to the bottom, and you can see. Now, sometimes it breaks out a little bit, but it doesn't break out for long, and it comes back. And then we can see the consolidation. So again, these are our Bollinger Bands that we're looking at. That's the red, the yellow, and the green. So yellow is sort of that's the 20-day moving average. The red and the green are 2 standard deviations outside. And so typically that stock is going to float between the red and the green. And even if the Bollinger Bands are in an upward direction, it still usually is going to float between those two bands. And so if we go back and look at history, I mean, I can go back, I can just keep going back, and you can see, I mean, we're looking back in 2022, you can see what it does. So those Bollinger Bands are real critical if you are buying stocks and you already have identified a great stock. You already know what it is that you want to purchase, but you don't know when to purchase. Those Bollinger Bands can be huge. They can be a huge play. Now, sometimes, like I'm going to go down here and take a look here. Sometimes, you know, the Bollinger Bands may fool you. Like right here, see it touched and it kept touching, and look at how this thing just kept dropping over time, even though it was hitting the bottom of the Bollinger Bands. So the long-term direction of this was in a downward direction. And then it sort of started leveling out, and then we could see it start picking back up. So if you had bought, you know, up here where it touched the Bollinger Band right now, it would have taken you, that was back in March of 2022, it probably would have taken you, until, shoot, that was March of 2022. It would have taken you until about this time, which is June of 2023, for you to get back to where you need it to be. So the Bollinger Bands are not like, you know, definite, but they are a great indicator. They are a great indicator. All right. All right. So Carrie, if you'll drop your question in the chat or drop your question down in the Q&A, we'll take a look at your question. All right. All right. So what I'm going to do tonight is I want to move on to something else tonight. I want to talk tonight about dividend investing. And so that's what we're going to cover here tonight. So let me go ahead and share this, publish this to the web, and we'll get into dividend investing. I just wanted to cover that Bollinger Bands again one more time because they definitely work, and I just want to make sure that you understood that. Now, a lot has went on this week. We know that Charlie Munger passed away. That was Warren Buffett's right-hand man. So, you know, rest in peace to Charlie, right? A very smart guy. And a lot of my trading is based on his thoughts and how he operated. So again, when you take this class, my goal is for you to learn the basics of investing and to learn how to stay safe and not take great risk. That's what I teach. I teach you to stack the odds in your favor and not to take great risk. Now, we were talking about Uber earlier today, just a few minutes ago. Uber is not a stock that if you're trying to keep and stay safe, I still think that Uber can go one way or the other. But I do think that if you're looking for a growth stock and you want to take some risk, that could potentially be a stock that you could take a look at. But it is not a stock that is a for sure thing where you stack the odds in your favor, okay? But every now and then there's a stock that comes out that you're like, I'm gonna go gamble it, right? I'm gonna roll the dice on that. And Uber might be one of those. But tonight we're gonna talk about dividend investing because dividends are an important key aspect of your investing. And we're gonna learn how to generate income from dividend paying stocks, okay? And so this is very important tonight for you to learn. The goal of our course is to teach you how to create income without selling your stocks. So you can make money in the stock market and never sell your stocks. So the reason why I have so many shares of Microsoft, one, because I love the company, but two, even though I've never sold my Microsoft stock, it continues to pay me in dividends. Now, for me, I do what's known as the drip. I take all of the money that I make from Microsoft and I go back and buy more shares. And so that's how I build up my shares. But at some point in my life, when I get ready to retire, and I'm going to want to have some income coming in, instead of doing the dividend reinvestment, I'm going to actually have them cut me a check. All right. So we'll talk about that here tonight. Okay. So let's talk about what is a dividend. A dividend is simply a distribution of the company's earnings back to the shareholders. Some companies give great dividends, other companies give a partial dividend, and then some companies don't give dividends at all. And so this cash, when a company is giving out dividends, they are not really a growth company. Growth companies don't give out dividends. But when you have established companies, when you've got a Coca-Cola, you got a Microsoft, you got those types of companies, they like to give back a portion of their profits, of their earnings, back to their shareholders in the form of dividends. And so we looked at free cash flow. If you remember, when we looked at the fundamental analysis, we looked at free cash flow. And free cash flow is where you would determine and see that a company has enough free cash flow that they're willing to start paying out dividends from their earnings, okay? Because remember, free cash flow is like, I done paid everybody, I done paid everything, and here's the extra cash I got left over. What do I do with that, right? And so for some companies, they pay out dividends. Other companies, they might do more research and development to create more products or to create more technology. But tonight we're talking about dividends, okay? And your dividends are paid based on how many shares that you actually own, all right? Now, why is dividend investing so important? Why do some people look for companies that pay dividends and that's what they invest in? It's an excellent way for you to generate income if you're a long-term holder. So typically when you're looking at companies that pay dividends, they're going to be solid companies. You're going to be looking for companies that pay regularly. So once a quarter, they're paying dividends and they're increasing their dividends every year. You're looking for you're just looking for really good, solid companies that are willing to pay some of their earnings in the form of dividends. And it's one of the safest methods of you getting paid for owning a stock, okay? And so a lot of people would say this. They say, well, I have monthly bills. I want monthly income. And so I've seen people that have taken this approach to dividend investing. They would say, okay, I have a cell phone bill. My cell phone bill is $60 a month. I'm going to go buy AT&T or Verizon, and I'm going to buy enough shares of AT&T or Verizon that it pays for my cell phone bill. Okay. So, if AT&T is paying, whatever they're paying, it would kind of tell you how many shares you need in order for you to have your cell phone bill paid for the rest of your life. Then they might say, okay, I got a utility bill, I got an electric bill. So I'm going to go get, South Carolina Gas and Electric, or I'm going to go invest in Duke Energy or whatever. And I'm going to invest in those companies and I'm going to get enough dividends to pay for my utilities. And then, so their whole mindset is they're buying stocks that pay dividends and they want to eventually grow their stock portfolio to a point that the dividends could take care of their monthly expenses in life, right? So that's where people go for dividends. And when you're retired, dividend investing is a great thing. Now, there are a couple of dates that you need to know about when it comes to dividend investing. We're going to go through these 4 different dates. The first date is the declaration date. This is when the shareholder, when the board gets together and they decide when the dividend will be paid, how much and when. So the board of directors get together and they declare that we're going to pay the next dividend on this particular date. That's the declaration date. The next one is the ex-dividend date. All this means is that in order for you to be qualified to receive the dividend, you must own a share or shares of the stock by this date. to qualify for the payout. So if they pay out dividends, let's just say they're going to pay out dividends tomorrow, which is December 5th. You can't buy the stock on December 4th and expect to get paid dividends on December 5th. So the ex-dividend date is the date that you have to be an owner of that stock in order for you to get paid dividends on that stock. Now, let's just say that the ex-dividend date was November 15th. You bought the shares on November 14th. November 15th came around, you still owned the shares on November 15th. And then November 16th, you decided to sell the shares. Now, the dividend payout is December 5th. Do you get the dividend or not? The answer is yes, because you were the owner of that stock on ex-dividend date. Whoever's the owner on ex-dividend date will get paid the dividends on the payment date, which is the fourth one. They'll get paid the dividends on the payment date, even if they don't necessarily own the stock after the ex-dividend date. You've got to own the stock by ex-dividend date. Then you have the record date. The record date is the date that the company goes down the line and says, who owned this stock on ex-dividend date? Who are the shareholders that own the stock on the ex-dividend date? So that they can determine who they're going to pay. And then the payment date is the day that you actually receive the dividend. Okay? So hopefully you guys know what those are. You're going to probably hear more people focus on ex-dividend date than any of these other dates, because they want to know, when should I own the stock in order to qualify for the dividend? Now, let's talk about dividend paying companies. What does dividends represent when a company is paying dividends? What a company will do is they'll work really, really hard to keep consistent, slow rising dividends. This is a good company when you see year over year, the dividends are rising. Okay, last year they paid 50 cents. This year they're paying 52 cents. The next year they're paying 54 cents. That would be a slow rising dividend, and you want to see that. Okay, they increase slowly, and they're cautious about how much that they do because they want to maintain for the future. All right. Now, you're going to want to know these. These are dividend royalty. And so you've got three different types of dividend companies. You got dividend kings. Now, the dividend kings have increased their dividends every year for 50 years straight. All right. These are S&P 500 companies. Let me say that as well, because they got to be in the S&P 500. They have to have paid dividends for the last 50 years. And every year, the dividends have had to grow to become a dividend king. A dividend aristocrat is in the same category, S&P 500 company. They've increased their dividends every year, but they've done it for 25 years. Okay. And then the dividend champions are people that are companies that are not in the S&P 500, but they've increased their dividends for 25 years straight. Okay. So as you can see, being in the S&P 500 is a big deal. So today, when Uber announced that later this month, they're going to be added to the S&P 500, that's a pretty big deal. Okay. But the dividends have to be consistent and have to increase over the period of time, as you see here on the screen. Okay. Now, why is that important? Because like you can see here on the slide, there have been some tough years. 2008 to 2010, the Great Recession, as well as 2001, the dot-com bubble burst. But if a company, even though there was a big recession, the pandemic, all of those things, but they still paid dividends and they still increased their dividends, that lets you know that you got a strong company, a strong company. So when you're looking at dividends, you're looking at companies that are very, very strong. Okay. All right. Denise says, do you have to hold the stock for a period of time before receiving a dividend? So Denise, all you have to have is you have to be the owner of the stock by X dividend date. You just need to be the owner of the stock by X dividend date. So Again, if ex-dividend date was November 25th, the dividend is being paid out on December 5th. If you own the stock on November 25th, then you will get paid the dividend regardless of what you do after November 25th. Okay, so you got to have the stock by ex-dividend date. All right, good question. All right, so we've got our dividend royalty. Let's move on. Let's talk about something else here. How do we pick dividend stocks? Okay, so what we're looking for is we're looking for a company that has consistent profits. You remember we're looking at these top line revenue. We're looking for companies got more cash than debt. We already looked at that. That's fundamental analysis, right? We're looking for companies that got strong cash flow. We already did this. We're looking for a steady increase in dividends. Now, that was something that we haven't looked at. We'll look at that here in a moment. I'm looking for stocks that have paid dividends for more than 20 years. So they're coming up on being a dividend aristocrat, or even a dividend king. We're looking for companies that pay a dividend yield of 2 to 5%. Anything greater than 5%, you got to be careful because they can pay out too much in dividend. You don't want your company to pay out too much in dividend, okay? And then we're looking at the payout ratio. So these are a couple of things that you're looking at when you're looking at a dividend stock company. The reason why I like these bullet points is because we've pretty much looked at these when it came to fundamental analysis to determine what's a good company, okay? And so we're going to look at that steady increase of dividends over a period of time. Now, this is what I was telling you about. You can be a young guy like myself. I don't need the dividends right now. I don't need a check on a quarterly basis. So what I did is I said, when I bought Microsoft, when I bought Nike, when I bought American Express, when I bought all of those companies, I said, when they pay out dividends, I just want you to reinvest back into the company. So the dividends actually buy me more shares right now. But when I get to the point where I want to check, instead of buying more shares, I want to check, then I'm going to uncheck that box and say, okay, when you get ready to pay the dividends, send me a check. Okay. So what dividend reinvestment does is it automatically purchases additional shares when you receive your dividend. Okay. Now, in some cases, you can buy shares commission free. Well, nowadays, everything's commission free, so that's not a big deal. You might be able to purchase the shares at a discount. I don't see that happening too much nowadays, but back in the day, you were able to do that. Here's something that's interesting. You can buy fractional shares. So you got to pay the dividend. Let's just say you got to pay the dividend of $10, but the stock is actually $100. Well, you would get 1/10 of that share. Your dividend would buy 1/10, so it would buy a fractional share. Now, the other thing that you do need to know is that your dividends are still reported as taxable income. So even if you don't take the money, but you buy more shares of that particular stock, that dividend will be reported on your taxes as income that comes in, unless you have it in an IRA or a 401k or something that's tax deferred. But if you just have a regular stock and it pays out dividends, you will have to pay taxes on that on those dividends. Okay. All right, let's see what we got here in the chat real quick. Yes, AT&T paid too much in dividends, and AT&T had to slow down, and they lost their footing because AT&T was a dividend aristocrat at one point, but then they had to change their dividend payout, and they lost that status. They lost the status. But AT&T pays hell of a dividend. We'll look at that at AT&T since you brought it up. Let's talk about Coca-Cola. And I want to talk to you about the power of the drip. You know, the kids, they call it drip. I think drip for the young folks is like your clothes or whatever. You got that drip. You know, you got that drip and you're looking good or whatever. But we're talking about the dividend reinvestment plan or dividend reinvestment program. if a shareholder were to have invested $10,000 in mid-June of 1962 and held it until mid-June of 2012, which was a period of 50 years, this is what they would have gotten. If the dividends were not invested, you will have received $136,000 in cash, that's dividends, and the value of your stock would now be $503,102. So you would have got $136,000 over that 50-year period in dividends that you spent. You got a check every quarter. You spent that money, got the check. And then at the end, you would have $503,000. However, if instead of getting the check and you would have just took that $136,000 and just let it buy more shares of Coca-Cola, if you had reinvested your dividends, your portfolio would be worth $1.74 million. That's right, $1.7 million. So when you're buying and you're investing, sometimes you got to invest for the future. So what it's allowing me to do is allowing me to buy more shares of the stock on a quarterly basis by reinvesting my dividends. I didn't have to do nothing for it. It didn't cost me any extra money. The company is paying out dividends, but instead of giving me the cash, I just tell them to buy more shares of that stock. And this is a prime example of why that's the case. Because in the first example, the person netted about $639,000. We just call it $640,000. But if they had reinvested, that's a difference between 1.7 and 640,000. And you can see on the screen the picture of the Coca-Cola company. The burnt orange is dividend reinvestment. The brown is just the stock growing and you keep cashing the check, okay? So it can be huge. In the beginning, you can't even tell the difference. But you can see that after several years, 10, 15 years, it starts to break apart. So see how in the beginning, reinvesting your dividends really doesn't make a difference. You can't even see the difference. But as you get further along, it becomes a big difference, okay? All right, let's move on. Let's talk about the real truth of a dividend yield. So this was back in 2021. I was teaching this class and we were looking at AT&T. And at the time, AT&T was trading for $30.01. So I'm going to write that down on my paper here. That back in March of 2021, AT&T was trading at $30.01. Now, the dividend yield that AT&T was paying was a 6.9% dividend yield. That's huge. That's, I mean, you know, you start getting above 4%, it becomes really, really crazy. So that means that for every share of AT&T that you own, you would be making $2.07 a year in dividends. They're going to send you for every share, they would send you a check for $2.07. Okay. Now, here's what happens though. Let's just say that in 1 year, AT&T, the stock is now worth $40. So the stock went up to $40, but the dividend yield stayed the same. So let's just say that they continue to pay the 6.9%. The fact that you bought it at $30 and got 6.9 and you're still holding it, now the stock is up to $40 and you're still getting 6.9, but look at how much your check has grown. Your check has grown from 207 to 276 because the dividend yield never changed, but the 6.9% is based on the current price of the stock, which is $40. You didn't buy it at $40. You bought it for $30. And so because you bought it for $30, your dividend yield is really 9.2. So you can see how by holding a stock long term, and as that stock begins to grow, yes, they're going to show the dividend yield for that year at 6.9%. But what if you bought the stock back when it was $10? Your $10 at 6.9% would only be what's that? At $10, 6.9% would be 69 cents, right? You get 69 cents. But now you're getting $2.76 because it's $40 years later. So your dividend yield is not 6.9%. It's going to be far greater than that. Okay. If you're getting $2.76 and you bought it at $10, your dividend yield is 27%. Hopefully that makes sense to you guys. So that's what we call the real truth about dividends, because your dividend yield can change based on, or will change based on the price when you bought it, not where it is today. And hopefully the price of the stock is higher. And even if the dividend yield stays the same, your dividend yield is different than the written dividend yield because you bought it at a lesser price. Okay. I hope that makes sense. We'll look at some and we'll see how that works. But now, if you're paying high dividend yields and you start having some problems with your company, you might be in trouble. And we'll take a look at AT&T at what they're trading at today. Okay, so let's go over here to Yahoo Finance and let's just take a look at AT&T today. Okay, so we can see a problem. We can see a problem. There's a problem. So when I did the presentation, and that was back March of 2021. March 2021, AT&T was trading for $30.01. They were paying a 6.9% dividend yield. All right. So if you bought them for $30 and they were paying a 6.9% yield, and now today they're at $16. That's half the price. And we look at their yield. Here's the yield. And let me see if I can zoom this in or zoom this out. I don't know why it's doing that. You know, Yahoo Finance changed their look. Let me go back to the classic. Let's go back to the classic look. I'm going back to the classic look. I hadn't got used to. So we're back at the classic look. So look at this. They're actually paying almost the same in the yield, 6.62%. But their dividend is $1.11. Now let's compare that to 2 years ago. The dividend was 6.9 and it was $2.08. So see, in this case, because the stock price dropped, so did your dividend. And so technically, you're not getting 6.9. You got 6.9 2 years ago when you bought it at $30 and they were paying 6.9. But now that it's $16, you're getting roughly about 3.5, maybe 4% dividend yield. Even though when we go here, it tells us it's paying a 6.2%. It's paying 6.2% based on this price. And you didn't buy it at this price. You bought it for $30. So see, we want to be careful of going after stocks that just have high dividend yields, 6 and 7% dividend yields. I want a good dividend yield, but I don't want it so good that it may tarnish the company or may hinder the company and make the company's profits fall. I hope that makes sense to you guys. Okay. So I want good dividends, but not so good that it hinders the company's growth. And AT&T had a lot of issues. They needed to get rid of some debt. They needed to get rid of some of their companies that they had, and they just dumped some of the things. And because they did that, they lost their footing, right? And they lost their status as a dividend aristocrat. So they got to start all over again. So they're not even going to be qualified as a dividend aristocrat at least for another 24 years, 24 years, right? All right, so now let's take a look at dividends. I'm going to go back to our chart, and we're going to take a look at how to determine a company paying dividends over a period of time, over a long period of time. So I'm going to look at max here. I'm going to click on max, and then we're going to scroll down, and I'm going to zoom out. And what you're going to see is you're going to see these little gray boxes called D's. They got D's in them. Throw some D's on it. Y'all remember that? Okay. The D's indicate dividend. Okay. And so I'm going to show you, we're going to see how the dividends have grown over a period of time. Okay. All right. So let's go back here to 1994. 1994, you were getting 19 cents basically. And then we go to the next dividend, paid out 19 cents. Next dividend paid out 19 cents. And then it went to 20 cents. That's the next year, the first quarter of that year. Okay. And then it should be 20 cents for four consecutive payments of 20 cents. Now this next D, which should be a new year, it should be more than 20 cents. 21 cents. So we'll look at that 4 times. 21 cents here, 21 cents here, 21 cents here. Then the next year should be more than 21 cents. 22 cents. 22, 22, 22. So as you can see, year over year, the dividend is growing, not by much. They don't have to grow by much, but they're growing year over year. And if they do this for 25 years, they'll be considered a dividend aristocrat. If they do it for 50 years, they will be considered a dividend king. Okay? And that's what we're looking at. We're looking at how much is the dividends growing year over year. And we can see that it's growing, right? We can see that it's growing. 25 cents, 25 cents. Okay, 25.6. Didn't grow a whole lot, but it grew, right? Boom. 27 cents, 27 cents, 27, 33. Okay, 38. That was a big jump. Now here's the problem. This is where they made a problem. On October 8th of 2003, they were at 38 cents for their dividend. The next quarter, they went from 38 cents to 31 cents. Boom, they just got kicked out of dividend aristocrat. They got to start all over again. Does everybody understand that? Your dividends have to increase year over year. You can't decrease and then get in that status of dividend aristocrat or dividend king. All right? All right, let me see if there's some questions that are here. Is there a faster way to tell than looking at each D? Yes, yes. We're going to get there. We'll get there. Okay. All right. So Lawrence asked a question that was really important. He says, is there a faster way? So Lawrence, this is what I like to do. What I like to do is I like to go over to Google, and I'm going to say dividend kings list 2023. So I just want to see the list of the dividend kings for 2023. Okay. And so right down here, it gives me a list. So I'm just going to go ahead and click on that list. And it's going to tell me who are the companies that's paying the dividends and are dividend kings. These companies have paid consistently 50 years plus. So we can see 3M. That's the tape company. That's the sticky note company. They've paid dividends consistently and have increased their dividends over the last 66 years. Abbott Laboratories, Abbey, ABM. Some of these you may not even know. I'm just going to scroll down here to some that we might know. There's Coca-Cola. Coca-Cola is going to pay. Colgate-Palmolive, right? So again, when we start looking at how do we determine what companies we want to look at to invest in, if you're concerned about dividends or you like dividends, then what you may do is you may come here and get a list of all the dividend kings and then go through your list and say, okay, now that I've got my list, now let me go look at the fundamentals. Okay, once I go look at the fundamentals, maybe I get a list of 20 or 30 of these that I'm looking at, and I narrow them down to 10, and then I look at my fundamentals, and then I say, okay, once I looked at my fundamentals, I narrow it back down to another 5, and now I got 5 good dividend paying kings that meet my fundamental analysis, and now I'm going to do my technicals to show me when to buy. I hope that makes sense to everybody. Okay, so what we're doing is we're stacking the odds in our favor. Everybody loves a good dividend paying company. So why not go with the best? I'm going to go with the dividend kings. And then I'm going to narrow down my dividend kings down to, the dividend kings with good fundamentals. And then from the good fundamentals, I'm going to then look and see which are the prices, where the prices at, and I'm going to set my Bollinger Band and take a look at where they are on my Bollinger Band. I hope that makes sense. So we'll just scroll through here and see. Genuine Parts Company, right? That's that blue and yellow company, I believe. Hormel Foods. Some of y'all ate some of their soup and some of their stew. Johnson & Johnson. There's the baby powder, right? Kimberly-Clark. Some of y'all done got some toilet paper to wipe y'all butt. Lowe's. Lowe's is the Home Depot's competitor. Okay, they've paid. Let me see if I know any others that stand out. PepsiCo. It's Pepsi. Procter & Gamble. You'll notice that a lot of the consumer goods, the food companies, are here because they're pretty stable. Think about how much Procter & Gamble been around since my grandma was around, right? Colgate-Palmolive been around since my grandma was around. Johnson & Johnson, they've been around for a long time, and everybody uses them. Stanley Black & Decker. Some of y'all like the power tools. Target. Tootsie Roll. What about Tootsie Roll? We're going to look at that company. We're going to look at Tootsie Roll. Granger and Walmart. So these are all your dividend kings. All right. Let's take a look at Tootsie Roll. I just want to see what the price of Tootsie Roll is. TR, Tootsie Roll. That's $34.32. Okay. Let's take a look at the trend on them. I'm going to look at the max. They're in an upward trend. Y'all see Tootsie Roll? Tootsie Roll's in an upward trend. Isn't that pretty amazing? They're in an upward trend. They pay a 1% dividend yield. So they pay about 36 cents for every share that you actually own. Okay. Not a whole lot of volume. I guess people don't think about buying Tootsie Roll, but by looking at the chart, now they've had a major dip here, but they seem to be back on the rebound. Okay. And then maybe what we would do is go and take a look at the financials. Let's look at Tootsie Roll and look at what kind of the numbers look like. 523 million, 471 million. So there was a drop there. But again, that was during the pandemic. So, this year, that 2020 was one of those years that everybody just, you got to just kind of scratch that one off. 566 million, 681 million. And then the last 12 months is 757 million. So what we are seeing is we're seeing top line revenue growth. This company is growing year over year, Tootsie Roll. So then we'll scroll down here to take a look at their net income. just to make sure that they're not losing money. And sure enough, net income is actually growing as well, except 2020. But like I said, we know what happened in 2020, but their net income is growing as well. So when I look at the income statement, I'm pretty excited about the income statement. You know, we can go take a look at the balance sheet. We go look at the balance sheet. We can see what they've got cash on hand. So they've got roughly about $149 million cash on hand. No, I'm sorry. Is that 149? It says in thousands. Yeah, $149 million. Yeah, because this is in thousands. All right. So we see what they got in cash. Let's take a look at what their debt is. Current liabilities, current debt. So we can see their current debt, right? So that would be about $1 million of debt, but they've got $149 million in cash. I'm cool with that. I'm cool with that. So see how we're starting to break this down? So we went through that. We looked at the balance sheet. They got any cash flow? Let's take a look at their cash flow. And what am I looking for? I'm looking down here at the free cash flow, right? Do they have any money left over? They got money left over. They had more money left over in 2019. It seemed like they're getting less and less money left over, but they got some money left over, right? So based on a lot that we've learned already, Tootsie Roll wouldn't be a bad company, especially if you say, you know, because a lot of people get stuck on price. So for $34.32, Tootsie Roll wouldn't be a bad company. Now what are we going to do? Now we're going to go look at the chart and see where Tootsie Roll is on the chart as it relates to our Bollinger Band. So we've already established our Bollinger Bands. So I'm going to zoom in. We can see that Tootsie Roll is riding pretty high right now on the top of this Bollinger Band. It's very close to the top of this Bollinger Band. So now may not necessarily be the time to purchase Tootsie Roll. We're just going to follow it. We can see how it was hitting the bottom of this Bollinger Band for a minute, and now it's bounced off and it's come back up, but we don't know what direction it's going to go in, and it's too close to the top of this Bollinger Band for me to make a decision. So this will be one that I'm just going to watch. But there's Tootsie Roll. Everybody see that? All right. So let's see if there's any questions that you guys got out there. Barbara says, in regards to X date, I think that you have to be in the stock when the market opens on X date, not buy it that day and expect dividends, right? You have to be an owner of it on X date. So if you own it on November 15th, then if you buy it on November 15th, you are an owner. So you can buy it on X date. If you own it by November 15th, okay? That's what X date means. If you own it by November 15th. So if you buy it on November 15th, that means that you own it by November 15th, okay? All right. So you are the owner on November 15th of that stock. All right, great question. Let me share something else with you guys that I did not share during fundamental analysis that I think I want to share now. When you find companies that you really like and you want to know about the company. So for example, I know Microsoft really, really well. And here's what I do, or what I've done. So what you want to do is you want to type in the name of the company. So I'm going to type in Microsoft, and you want to use this word, investor relations. Okay? Whatever the name of the company is, investor relations. And when you do that, it's going to take you to the investor relations page. And on the investor relations page, you're going to get all the information that you need to know. You can listen to the last investors call. You get all of this information. So we'll click on view details. This will tell me everything that they said, what the revenue was, okay? It's going to tell me what products, how the products did. So we know that office commercial, that revenue was up 15%. We know that office consumer, okay, that was up 3%. We know that Microsoft owns LinkedIn. LinkedIn revenue increased 8%, right? Xbox increased 13%. Search increased 10%. So we know exactly what each department is doing inside of Microsoft. These are things that you want to know, right? You want to know about what they're reporting. So it gives you all of the details. It tells you what Microsoft is doing, what's coming up next. It tells you about everything that happened at their earnings call. So you get all of the information from the earnings call, which is critical, right? This is critical because you've selected this stock. This is your baby. Microsoft is my baby. So I need to know everything I can about Microsoft, right? I need to look at the slides from the earnings call. Well, guess what? Here it is right here. I click on the slides. Now I'm looking at the same slides that the CEO of Microsoft did for the earnings call. This is the same slides that he did, that he talked about what they were doing, how they're doing, how they're growing. Why? Because I'm a part owner. Remember, I'm a shareholder, which means that I'm an owner of this company, and I'll demand and I want to see all of the information that you put out on a quarterly basis about how well my company is doing, because I'm an owner. And all you got to do is do investors relations. So, for example, that was the PowerPoint. You can listen in too. I don't know where the press release and webcast. The webcast is going to be where you can listen in to the call. Might be right here. It's around here somewhere. There it is. So we can do webcast. You see where it says webcast? So with a webcast, what we can do is we can actually listen in to the actual call. So this is going to download, the video is going to download, and we can actually listen to the actual call. Okay. Why? Because I'm an owner. I'm an owner of the company, and I have a right to hear what the CEO of the company is saying. How well did we do? How well did the company do for the quarter? So you have the ability to get that information. Okay. All right. I'll do another one. Home Depot. Investor relations. You just put in the name of the company, investor relations. It's going to take you to that part of the company, and it's going to tell you all the things that you need to know about Home Depot from a stocks perspective. You notice we're not looking at tools right now. We're looking at what the company has done, financial reports, stock information, events and presentations, okay? What they're into, what's going on with the responsibility, ESG reports, diversity and equity and inclusion. So you're learning what's going on with the company, supplier diversity. If you're into that, you get to know about your company. What's the foundations that they have? Serving veterans, disaster relief. But I'm concerned with investor relations. I want stock information, financial reports. I want to know about all of this. So if I'm investing in Home Depot, I'm going to go to my investor relations page, and I'm going to learn everything I can about Home Depot. because my goal is not to be investing in 20 different stocks. My goal is to invest in maybe 3 to 5 stocks. So I only need to know about 3 to 5 companies and know them extremely well. I hope that makes sense. We'll do one last more just to show you that this does work. We just saw Uber. So we go Uber, investor relations. Boom, it's going to take me to the investment relations page for Uber. And it's going to tell me what they're doing, all the things that they got going on. It's going to tell me diversity, inclusion, privacy, safety, ESG. It's going to tell me all of these things. I want to know what's going on. I want to know. I want to know everything that's going on if I'm investing in this company. So before I invest in Uber, even though I'm like, yeah, I might invest in Uber. Before I invest in Uber, I'm coming over here and I'm gonna learn everything I can about Uber, right? It's telling me that the revenue grew 11% year over year. All right, I kind of already knew that, right? It's telling me about the bookings. All right. Let's see if there's any other information here. I'm gonna just kind of zoom in so you guys can see some of this. I want to learn about the company and see exactly what it's doing, right? I want to know the difference between mobility bookings, delivery bookings, freight. I want to know about this stuff because I'm going to invest in this company and I want to know what they're actually doing. So it says delivery revenue was negatively impacted by business model changes that classified certain sales and marketing costs as contra revenue by 360 million. So see, this is the stuff that you're going to start learning about the company that you just can't learn from Yahoo Finance, right? This is getting right in the back seat with them and looking at all of the information that they're providing, getting down to the details, down to the nitty gritty. You want to do that before you start saying, hey, I'm going to invest in this company blindly. All right. All right. Hopefully that makes some sense there. I'm going to stop here and we'll answer any questions. Sonia says, when we reinvest the dividends, how much does a person pay to reinvest? You don't pay anything. You just, it takes money and it reinvests it. How can I find out? Is there a maximum, minimum amount? Can you give an example or show us? Let me see. I'm going to show you how easy it is to do that. Let me see if I can just find something real quick. I said I was going to stop. So stop doing this. Give me 1 second here. I know you guys are looking at my face. I'm logging into one of my accounts. So let's take a look at this account and let's see if it shows. All right. Let me see if I can see. I don't see it here on my account here, but typically when you buy a stock, there is a checkbox that will allow you to just say, I want to have my dividends reinvested. And I don't see it here on my account, but I know I set it up for that. I'd have to find it. I don't know where that is right now, and trying to go my Charles Schwab, but that's not working for me. One more second. I'm gonna try one of my other accounts and see if that shows it pretty easily. If it does, I will share that screen with you. Let's take a look at this. Okay. All right, so here we go. Just for you, Sonia. Just for you. So here's one of my accounts. And in this particular account, you will see that I have American Express. And if you come all the way over here to the right, it says, do you want to reinvest? And I've checked yes. And if I hover, it says dividend reinvestment. You see for Microsoft, do you want to reinvest? Yes. Okay. And so if you look here, it basically says your current dividend instructions are below. Reinvest dividends, yes. Okay. And that's all you have to do. And so when it's time for it to pay dividends, because you said that you want to reinvest, they just take your dividends and buy more shares of Microsoft. You don't have to do anything. You don't have to say anything. It just happens automatically. Okay. All right. And on my this account, I got Microsoft in this account as well, but I don't. It's in here somewhere, but it's easier on Charles Schwab, but I forgot where it was on E-Trade. I forgot where it was. Okay. All right. So let's see if there's any other questions there. All right. All right. All right. All right. Any other questions that anybody has? No questions? Fidelity has that as well. Yes, all of your brokerage accounts are going to have that. Fidelity is one of those companies that's going to have that as well. All of your brokerage companies are going to have it. It just may look a little bit different than it does from one brokerage firm or one brokerage platform to the next. All right. Any other questions? Let's see here, Barbara. All right, Barbara, we'll check that out. I'll check that out, Barbara. All right, no questions. If you have a question, Carrie has a question. I'm gonna go ahead and let you unmute your mic, Carrie, go ahead. Carrie, you can go ahead and unmute yourself. All right, I'm gonna assume that you didn't mean to raise your hand. Anybody else with their hand raised with a question? All right, how many of you are feeling more comfortable about stocks and understanding stocks than you did when you first got started? Anybody feeling a little bit more comfortable? Obviously, you're not going to be 100%, but is there people that are more comfortable understanding what you're looking at and what's going on in the market? Okay. All right. No problem, Carrie. All right, great, great. And that's the big point. Miss Selena Watson, she has her hand raised. I thought she did. It just went away. All right, good, good, good. And so that's really the key here, is to make sure that you have a pretty solid understanding of the fundamentals of investing. Now, let me say this, because we're right here at the hour to close out. Here's what I want to say, is that hopefully you came to this class and you realize that if you are going to trade individual stocks, hopefully you now realize that there's more to it than I'm just going to buy some stocks and see what happens. Hopefully you realize that there's homework that you got to do. There's some studying that you got to do. You got to read some things. You got to go to this website, that website. You got to look at, the charts. And hopefully you understand that there's a lot to it. So it's not gambling. Now, some people treat the stock market as a gamble, and that's why many of them lose money. But if you really want to learn how to trade stocks, like Lawrence just said, Mr. Lawrence just said, you got to put in the work. And so if you're not willing to put in the work, I'm going to show you what you need to do. If you're not willing to put in the work, because some people, after they come to my class, they're like, okay, I'm good. I don't want to do that. I don't want to do what you're showing us. Then what you need to do is you need to go over here to an account like Fidelity. You'll go over to Fidelity. I'm going to show you an easy way. This is an easy way. You go over here to Fidelity. You open up a free account with Fidelity, brokerage account, 0 commissions. You can trade ETFs and all that other good stuff. Open up a brokerage account here with Fidelity. And then here's what I want you to do. When you get an account with Fidelity, when you get over here with Fidelity, I want you to go over here and I want you to buy FXAIX, which is the Fidelity S&P 500 index fund. And if it's not Fidelity, Charles Schwab has an S&P 500 fund. Vanguard has an S&P 500 fund. What you're going to do is you're just going to go over here and you're going to buy the 500 index fund. You can see year to date, it has done 21% year to date. You can see what the average annual return is, 13. Over the last 3 years, it's been 9. Over the last 5 years, it's been 12. Over the last 10 years, it's been 11. These are great returns. You ain't got to go select no individual stocks. You ain't got to go do none of the stuff that you've been doing over the last 6 weeks. Take your butt over here, get you a Fidelity 500 index fund, and just start pumping money in it. And when you see me on my Facebook saying, yeah, I just bought some Google, you know what you can say? I got Google too. You can say, I got Google too, right here. When you see me talking about, man, Microsoft just did such and such, you can be like, cool, great, because I got some Microsoft too. Man, Apple just did so. Well, cool, I got that too, right? So for 95% of people out there, the best way for you to build your investment portfolio is to take your tail over here at Fidelity, at Charles Schwab, at Vanguard, and get the S&P 500 index fund and just keep putting money in it every month. You ain't got to look at the stock market. You ain't got to look at nothing. Just keep putting money over here every month. And you're going to wake up 20 years from now and you're going to be like, ooh, I'm so glad I listened to June. I took that class and it was hard. My head was hurting and I couldn't do all that stuff that he was doing. But man, I'm so glad I heard that one thing he told me to do. Open up a Fidelity S&P 500 account and just put as much money as I could in it every month and I'd be all right. And that's the truth. You know, you pay thousands of dollars for classes to learn how to trade stocks and learn how to do this and learn how to do that, when all people really need is for someone to just tell you what I just told you. Open up a Fidelity account, get FXAIX, and just call it a day. and just put money in it every month. Put it on automatic. Send money to it every month and look up 10, 15, 20 years from now, and you're going to be thankful, because if you did it last year, you'd be up 13% by now. If you did it 3 years ago, you'd be up 27% because it averaged 9%. If you did it 5 years ago, you'd be up about 60% because it averaged 12% a year, right? You can't beat that, especially if you don't want to go study and show thyself approved. You ain't got to do none of that. You ain't got to do none of what I was teaching you. You could have took $10,000 one time, put it in here in 2014, 10 years ago. Your $10,000 would be worth $30,000 today. That's what it'd be worth. It'd be worth, let me move my mouse over here. It'd be worth $30,522. You didn't have to read no charts. That means that your $10,000 tripled. You turn 10 into 20, you turn 20 into 30 in 10 years. That meant that roughly every 3.5 years, your money was growing. Your 10,000 doubled every 3.5 years. You didn't have to learn none of this stuff that you've been in for the last 6 weeks. And that's the reality. And that's my reality, what I've learned teaching students over the last several years. I've learned that what I really need to just do is tell them, take their butt right over here to Fidelity, get the FXAIX, and in 2 minutes, I could be done with my class. Instead of spending 6 weeks with y'all, I could be done in 2 minutes. And that's real talk. That is real talk. So if you don't get anything out of this class, if you're like, okay, I took the class, but I still don't know where to start, go over to Fidelity and get FXAIX and just get the pumping money in that. And that's it. It's that simple. We should tell the whole world that. If Fidelity would pay me real good, I just tell the whole world, go open up a Fidelity account, put money into FXAIX every month, and then don't worry about it. Don't worry about none of the other stuff. Just do that. It's just that simple. Tell your kids, look, open up a Fidelity account, put $200, $300, $400, $500 a month into FXAIX, and just do that for the next 10 years. Do that for the next 20 years. You ain't got to know nothing about the stock market. Melissa says, I can't get rid of y'all that easy. But it's the truth. Is it the same letters for Schwab? No, it's not. So each one has their own. So Charles Schwab, we'll go over to Charles Schwab. And what you're looking for is, I'm going to tell you what to search on. So if you're in Charles Schwab, I'm going to go to Charles Schwab, and I'm going to say S&P 500 Index Fund. That's all I'm going to search on. And for Charles Schwab, the S&P 500 Index Fund, let me see if I can find it here. It's going to be SWPPX. That's going to be Charles Schwab. So I'm going to click on that. So that's going to be the Schwab S&P 500. The symbol is SWPPX. Okay. And you can see, let's take a look at the performance. The performance here is going to be very similar to the performance that you've seen in others. 1 year, 10%, 3 years, 10%, 5 years, 10%, 10 years, 11%, since inception, about 8%. You can't beat it. You can't beat it. So when June says, look, you can get 8 to 10% on your money, I'm telling you, you can easily get 8 to 10% on your money. Year to date is done 10.6%. So if you had bought this and got into this last December of 2022, you would have made 10% of your money. You put $10,000 in, you'd be up $11,000. If you had been in Fidelity, you'd be up maybe a little bit more. I don't know why Fidelity says 21. That's big. They should be similar though. I don't know why it says that. They should be kind of similar because they're investing in the same thing. I got to look that up and see why Fidelity says. Let me see. That's 21%. Let me go back to Fidelity. 21%. 1 year, 13%. Oh, yeah, 13%. I don't know. Fidelity is a little bit different here. So if I had took $10,000 back in 2014, this would be worth 27,162. Fidelity, it was 30,522. So there's a little bit of a difference, but not much. Not much. Okay. All right. Great question. Let me check the chat, see what else is there. I'm going to keep buying individual stocks, but I'm also going to take my tail over to Fidelity and buy me some S&P 500 index. That's probably a smart move. Thanks for teaching us that using the Bollinger Bands are a great indicator for entry. Yep. Your information is invaluable. I've learned more in 5 weeks than I've spent spending a few $1,000s taking WAC classes in groups. I appreciate that, Donna. Appreciate what you're saying. Okay. And so what I just want to do is I want you guys to understand that it took me a long time to learn some of this stuff that we're learning. I don't know why my camera is out of focus there. It took me a long time to learn what I've learned, and I'm still learning. And the reality is that for the most part, if I was talking to my mama, to my brother, because my brother doesn't trade like this. My brother doesn't trade like this. He don't know trading. He's been through my class, and he's still, not trading because it's not for everybody. And so for my brother, hey man, go to Fidelity, get FXAIX. Can you afford to put $500 a month in it? Yes. Go put $500 a month in it and don't even look at it. I mean, that's how confident I am about it. Go put $500 a month in it for the next 10 years and go back 10 years and take a look at it. It's just that simple. Okay. Robert Blackwell, I see your hand raised. Go ahead, sir. We are listening.
Yes, sir. Hey, Mr. Collier, how you doing, sir?
I'm better than amazing.
Boy, I tell you, Mr. Collier, back in the days when we had to send that calls back in 2019, and I was working back and forth on the road, man. I was listening. One thing you said to me is you have to invest in your training to make sure you understand things. So I went on the technical side, learning stuff on training. Spent some money, a lot of money. I'm grateful I did, though. You know what I'm saying? But listen, sir, right here, what you're teaching right now, so all that stuff now will enhance what I already know. You know what I'm saying? And like I said, and people on the call right now, it'll be y'all in a blessed place to learn it from this level. You know what I'm saying? I mean, like I said, I see the high stuff, but to get like this right here, man, to break it down like that, that's a blessing, man. I thank you. I thank you for everything anyway, what you do, because you do so much for a lot of us. But I thank you, man, because now, look at me. I'm talking about, man, I learned that the how much your stock is and how to look at when they're growing over years or years, man, in detail like that, man. Come on, bro. Man, that's a blessing. I'm telling everybody on this call, y'all in the right spot at the right season to get this, because if you get it now, the way you're getting it now, like Mr. Collier said, y'all are gonna be blessed. And I'm telling you, man, I thank you, sir. Because I didn't look at this level. You know what I'm saying? When you get that all that extra just training you pay for, they all come at the high level. I mean, I understand what's going on, but it takes a lot. And like I said, it takes a long time for everybody to get to where, to learn what you're really doing. But I thank you, sir, because now I can go back now and look at it, the bottom line and see what's really going on. I appreciate it. You know what I'm saying? Thank you so much, man. You know, like I've been going through a lot lately, man, moving, doing all that stuff, man. But man, you know, I try to make the call every time I can, but I got a lot going on, man. But God done bless me, man, to come back home to be with my daughter in Georgia, man. So I'm right next door to you, man. A matter of fact, I get to that jump right by and throw the horn at you, man. So,
What part of Georgia?
yeah, my daughter, we live in Hartwell, Georgia, outside of Athens, 85
Okay.
now, going through South Carolina. Yeah.
Yeah, yeah.
Right now, I'm temporary in Atlanta, in McDonough right now. Uh,
Okay.
I got a friend that's there. You know, I think you might know Mr. Tommy, but anyway, he's there, man. So I moved my stuff there temporarily, and when I get back, I'm in Maryland right now. You know,
Okay.
take care of my folks in my econ, the ones that we trying, because we got some good stuff going on. I don't want to talk about it here, but people probably know. So
Yes, sir. Yes, sir.
a lot because I was a church here and I taught a lot of young kids in Sunday school, sir. And now they're engineers and all those things. So now I'm trying to take it back to them so they can get it the right way. You know what I'm saying?
Right.
Yeah, because it's a blessing, man. I thank you, sir.
Well, that's good. That's good. My brother lives down in McDonough, and
Okay.
yeah, he lives in McDonough and Hartwell. I'm off of 316 in Lawrenceville, so
Okay.
you
Okay.
jump
Oh,
on
really? Okay.
316, that'll take you straight to Athens. So
Yeah, that's right. Outside of Athens, sir. I got family in Athens, man. So I'm in Maryland. I'll be here for a week. Make sure I get everybody here tighten up on what's going on, so I can make sure they start growing. Cause, but I told everybody, I said, listen, it's time for y'all younger folks now. They have opportunity now to take care of the older ones. You know what I'm saying? Cause they got kids, and you know where they are. They're on social media, and you
right.
know what we do. You know what y'all got yourself doing out there now. Thank God for anyway, and thank God for everything, man.
I appreciate you, sir. I appreciate
Yes,
you. Thank
sir.
you so
Yes, sir.
much.
I touch bases, sir. When I get back in the area, make sure I touch bases because we got some stuff I want to talk to you about anyway. But hey man, been a ride. I've been growing businesses, man, and taking care of stuff. And I
Well,
thank
when you
God.
get back up this way, we'll do lunch.
Yes, sir. Yes,
All
sir.
right.
Yes, sir. Definitely. Okay.
All
Thank
right.
you, sir.
Appreciate
Y'all
you.
have a blessed night, sir.
All
Appreciate it.
right. You too.
Yes, sir. Yes, sir.
All right, ladies and gentlemen. It's just it is what it is. So we'll do another class next week because what I want to talk about next week is money management. So you've learned how to trade. Now you need to learn how to manage your money. And what do I mean by that? You don't take every dollar that you got and pour it on one particular stock. Or we're going to talk about money management and risk management. That's sort of the final piece because you got to know how to invest so that you don't put all your eggs in one basket. So we'll talk about money management and we'll wrap up this training next week. We'll finish up everything next week for all of your training. I hope you guys again have learned a lot. But I do want to give to those of you the option of getting a Fidelity account, getting S&P 500 index fund, and just running that play. So each and every one of you can teach somebody. You can teach somebody. If somebody asks you, how should I invest? What should I put my money in? Tell them to go open up a brokerage account, get an S&P 500 index fund, and just keep pouring money in that. And they'll be all right.
Yeah.
They'll be all right.
Yeah.
Right.
Yeah.
So that's the best basic advice that somebody can give you when it comes to investing. We watch all of these people on YouTube. We see all of these people on social media, and they talk about how they're making all of this money. Most of that's a lie because it just doesn't work that way. And for those that it does work that way for, they have spent years and years and years perfecting the craft and spent thousands of dollars to actually make it happen. Yeah. I spend probably $2,000 or $3,000 a year myself just on education. Okay. Mm-hmm. So if you ask me how much I've spent on education over the last 10, 15 years of trading, it's probably $40,000, $50,000 that I've spent to learn what I'm teaching you here tonight. And so this is a good step for you. But again, if you're saying, look, I see what it takes, and I'm not willing to put that type of commitment forth, ain't nothing wrong with that. Just know who you are. Know who you are, and don't mess up your money. And go over there and get you an S&P 500 index fund, and you're gonna be happy in 10 to 15 years, just like the rest of us. All right. So with that being said, I don't see any other hands raised, no other questions. We're going to go ahead and get out of here for tonight. We'll do one more class. That'll be next Monday, and then we'll finish out our class. Until next Monday, God bless, take care, and we'll see you guys soon. Good night, everybody.